Bhavin Shah of Sameeksha Capital is joining us right now on the show. Bhavin, thanks very much for taking out the time. Give us a sense of what kind of advice are you giving to clients at this point?
Well, the way we invest, we tend to look for bottom-up opportunities. And I think there are opportunities are there in the market at this point, even with fairly rich valuations in some segments. So I think we continue to stick to that approach, and we advise investors to if they have patience to deploy money in that fashion, and then that is the best way to go about it. We also have observed that over last 3 years or so, index funds have outperformed most of the large cap funds, and it's becoming increasingly impossible to predict which large cap mutual fund might outperform an index fund. So, we believe that every investor should have an index fund in their portfolio as a way to play large caps.
Okay, but just the fact that we're at record highs, Bhavin, does a staggered approach make sense? Or, the push for the markets right now, there's no trigger that can be negative, because we've seen the US equities also on a continuous basis making record high after record high. So the momentum is there. So one rather not miss out.
Well, yeah, see, what has happened is, if you look at India in particular, it would have made perfect logical sense to really sell down on equities post the budget. And that's what happened. However, I think, the way this government functions, they take a decision, then they see what happens, then they get feedback, and then they take corrective action. So while in my view, they have made a lot of mistakes, at the same time, they keep correcting them as well. And so it is prudent not to be out of the market, because, if I had done the logical thing, which is to really reduce my equity exposure post-budget, I would have, probably missed that big uptick that happened on the day of the corporate tax cut announcement. So I think that is that is the reason. And the other thing is, when you look at the current interest rates, and when you look at the revised tax rate, if you factor that into basically a equity yield versus bond yield equation, the market is not cheap. It is in our calculation, one standard deviation above the average on this metric, but it is not at the kind of a peak level in that respect. And I think that is probably the same reason why US market also has has kind of been very strong, apart from obviously improvement in trade war issue. This very fact that the interest rates are very low, I think it keeps playing a big role in the market.
Bhavin, Neeraj here, good afternoon. Where is it from amongst those well-performing pockets do you foresee an earnings momentum that could keep valuations elevated? We hear that for financials, there is skepticism about what can happen to some of the other pockets. Where is it within the spaces that you track, where you see earnings momentum continuing for at least the next 2 years, if it's possible to predict that?
I'll have to really, think hard on that. But I think you are right about financials. I think we are also starting to see some momentum in the, healthcare, for example, in the hospital space, where I think the capital intensity has come off. So, companies are starting to focus a bit more on profitability. So we are starting to see some of that operating leverage that particular type of companies have starting to kick in. I think beyond that, I think it's really going to be, depending on the specific companies in each industry where they enjoy, particular type of advantage, whether through cost or pricing power. Those, but I think it's difficult to make an across-the-board statement on that, beyond that.
Okay, let me try and ask this to you. A lot of arguments come in for how, because of the higher ROIC that some of these consumption names would enjoy, the higher multiples will stay. People may be skeptical, but those higher multiples will stay if they manage to grow at the same pace at which they are growing right now. One, is that a legitimate thing? And if so, would it be staple companies like HUL, Dabur, etc., which will continue to find that favor, or would even the other leg, the likes of paint companies, for example, which are Berger and Asian, etc., which are trading at higher multiples, would also continue to stay at those elevated levels?
See, I think what has happened is all these companies you mentioned, they've benefited from one common thing, which is the tax cut. So that resulted in a bit of a valuation reset for them. And I think people may get mixed up on that versus and then obviously earlier to that there was that GST change. I mean the introduction of GST, which actually favored the companies that you mentioned. Now I think how long can tax cut is a one-off. I think that's kind of factored in by the market. GST benefit probably still continues sort of that market share shift towards the organized players. But I think beyond that, it's there is I suspect that if the overall economy, if the economic recovery starts to take hold and the opportunities emerge in relatively more cyclical businesses, then money may shift towards that. And these stocks may actually underperform because I think valuations are definitely absurd by I think by any stretch of imagination. You can forecast till 2050 and basically plug in the realistic volume growth till 2050. India becomes as developed as China today in 25 years. You build in all those assumptions and I think you will still not find value in those names.
Okay. It looks like some of the cyclicals are really picking up pace. Metals as a pocket is a lot more active than it was a few months ago, and there are key triggers as well that's coming about. But do you see things taking some more time to pick up materially on ground with the domestic demand, pricing once again coming back in? Obviously all of that dependent on what happens with regards to the trade talks, but is this a space to be in, to have exposure in?
I don't think I can talk about metal, but I think overall on a broader picture, what I can say is, one of the root causes of what has happened in India has been the credit, availability, right? The slowdown in credit, the whole, crisis started with IL&FS. Now, if there are some signs, I think government, I think it also really pushed that agenda hard recently with, a fair bit of increase in loan basically loan approvals and so on. I think the credit growth was slightly better in the latest data. So I think if that picks up, I think that is probably going to be the key factor that will drive the broad-based economy. I think, and you can look at, for example, a very specific, if you look at the rural economy, for example, with a good monsoon, good reservoir capacity, I think the confidence in investing, could increase. Tractor, for example, could be one segment that picks up a bit early. So things like that, I think, and then it starts to spread. So that's how I would think about it.
Okay. What about IT? Of late, it's a bit sluggish. Not much has been happening out there. And probably for some time now, high teens kind of growth is something that has already been factored in. What would your take be?
I think it's still a good sector to have some exposure to, especially if it finds stocks that get beaten down for sort of very flimsy reasons, like what happened to Infosys. I think it's still not fully recovered to where it was trading before all that whole thing came out. Similarly, there could be some other opportunities, for example, in names like Mindtree maybe. But so I think overall, the sector continues to have a fair bit of strong sort of factors helping it grow at probably less than 10%, I would say, not even high, low teens. But at the end of the day, there is very high dividend payout from many of these companies, and I think you still have 3-4% kind of dividend yields on these stocks, and then there is some bit of growth, mid to high single-digit growth. So it is a good, it is a good sector to have some exposure to in a portfolio. It may give 10-12% return perhaps on an ongoing basis, But I think there is a fair bit of confidence in terms of the fundamentals of those companies.
One question, Bhavin, at least final question from my end. While we talk about a bunch of others, there is a sector which is hitherto been neglected, but 2019 has seen it do well, and that is real estate. And a bunch of portfolio managers as well that we've spoken to in the recent past seem to suggest that with the advent of RERA, there might be a meaningful shift in the way in which some of the larger organized players stand to benefit and gain market share from the unorganized, and therefore that will show in how these companies perform over the course of the next 5 to 10 years. Do you have such a structural long-term view on real estate?
I think it's a reasonable conclusion to draw based on what has happened in other markets. I think real estate has been sold in a very haphazard way in our country for a long time. I think acts like RERA obviously try to address that. And I think availability of finances and all obviously becomes key. I mean, there is still a fair bit of availability of cash or black money in the market, which still seems to be helping some of the second tier unorganized, quote unquote unorganized developers. So I don't see the shift maybe right after demonetization, GST, that time frame, one could have perhaps felt that maybe we are really moving away from a cash economy. But to be honest, to be fair, I mean, that is not the case. So while RERA does increase the level of compliance, I think developers beyond those big names who want to do projects and who are otherwise good in terms of execution are actually getting money. So I mean, I think that shift will probably happen, but perhaps less gradually. I mean, less quickly than maybe some people think that it will.
Okay, got that. Great chatting with you, Bhavin, this afternoon. Appreciate you taking out the time and joining us on Bloomberg Quint.